Okay, this will help you prepare your homework in Chapter 3. And this little exercise has you journalize 1, 2, 3, 4, 5, a half a dozen transactions here. And instead of like we did in Chapter 2, what we did in Chapter 2 is went directly to the accounts and say debited cash and credited capital inside the accounts, and then the accounts were updated at the end, and then a trial balance was prepared. But in Chapter 3, we're going to take the steps that are used in real practice, and that would be the book of original entry. Book of original entry is called a journal. So we record transactions first in the journal and then post to the ledger. So that's how we update the ledger, by posting, which is part of this problem. So there's the 8,000 that we're going to be journalizing, so keeping a record of what happens from day to day. Okay, journalize, post, then a trial balance. Those are the steps in the cycle. Journalize, post, then a trial balance. Then we move along, do some adjustments, then we do the financial statements. Those are the steps of the cycle, which we'll ultimately complete, I think, in Chapter 5. So the capital account has to be credited here to add to it. Of course, it gets added to once it's posted. This doesn't automatically post to the account. Real system, yeah, you click enter and the account is updated. There's an addition to cash and an addition right in the ledger. But this is like an old-fashioned way of doing things. But it is showing you the piece-by-piece construction of the accounting process here. So we need to explain on typically the third line here. They give you your options down here. What happened is that there was an investment in the business, owner investment. So we have to put that brief explanation in, and that's the first entry. I think we got it right. So we'll check answer. Let's see it. Can I adjust that? Yeah. Okay. So we can check the answer down here, and you'll see that you're okay. And then perhaps the second entry will show up, and it's dated the 4th. Equipment on credit. So it's just like we got to tell everybody what accounts are affected. Right, when we analyze, a piece of equipment came in, it's an asset, so we debit it, and the amount is $1,300, so we stick the $1,300 in there, and it's a credit transaction. We're not paying cash, but we are adding to the liability account payable. You know that accounts payable are going to be increased with credits, so when that gets posted over to the accounts payable account, it will in fact add to the liability. Debit assets to add to equipment in this case. Credit accounts payable to add to that liability. And the explanation, I think, should be the purchase of equipment on account. And it looks like that's correct. So we'll come on down here and check the answer. Hopefully we're okay. Good job. Okay. So you got them both there. The accounts themselves have not been updated because we have not posted yet. We billed, which means that we are performing a service, okay? And if we bill somebody, that means we haven't got the money. We did a job for somebody who's going to pay us later, so we put the $2,000 as an asset accounts receivable, knowing that we earned and have a claim, and that's what makes accounts receivable an asset, that we have a claim against the person to whom we sold our services. So we come down here and click the 2,000 in the fees earned account. And when it gets posted, we're going to be adding to the fees earned account. We're going to be adding to the accounts receivable account, being an asset. And I guess the explanation is down here. Service performed on account. I think that's what happens, right? So check answer. And nice job well done, whatever. Okay, so this is a cash deal. Okay, we performed a service and received the money right away. So you're going to come in and add to cash because you got the money, you brought it down to the bank, and your checking account goes where? Up. You get your cash balance, both in the bank and on the books, is going to go up by the amount of money you received and deposited. So that's a $7,000 addition to the asset cash, debit to add to assets, and we performed a service, so that's the revenue account. Okay, and that is increased, of course. So in the revenue account now, you see you're going to have like $9,000 if you are accumulating your balances in the account itself. That service is performed for cash. I think we nailed that one. And we did. Okay. And then we paid salaries for $1,000. So on the 24th, we're going to come in and debit salaries expense to add to the expense account. Debits add to the expense. You keep debiting salary expense, and every time you debit it, you're going to add to the amount of salaries. And then at the end of the period, it negatively impacts our net income. Which then gets closed to capital, so that the negative aspect of capital reduction is reflected through a debit that adds to the expenses, ultimately take capital down through less of an income because of the expense. Okay, so where am I? We paid, is that where I want to be? $1,000 cash. Bum, 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 bum. Okay, and then we're going to come down here, and salaries paid, looks like it's the one. Then we check the answer. Good job. And then finally, Jenna withdraws $200. We've got to whack her withdrawals account. That adds to the amount of her withdrawals. You keep taking $200 out, you're going to be accumulating. That's why you debit the withdrawals account in order to accumulate the amount of money that you reduce, that you take out of the business, which ultimately will get debited out to the capital account when we close, so that the withdrawals is a negative to the capital, but when we debit it, it's just like we don't debit capital directly, but we accumulate withdrawals in their own account. Then we close the withdrawals account into the capital account, and thereby will have a negative impact on capital. Okay, so that's the owner withdrawal, and I think I'm cool. Let me just check. Looks good to me. 200, 200. Okay, check the answer. And if you say so. Okay, back at it here. So you've journalized the transactions for the month, and now it's time to do the second step, which is to post every transaction to the general ledger, which is shown below. The transactions came from journal page 1, so that's going to be our reference when we go to the ledger, as you'll see in a moment. I'm going to post 2 of these for you manually. It takes a lot of time to do each one, so what I'll do is I'll pick up from the transactions and pop them in as postings, and you knowing and realizing that they would be coming from the journal over here. But because you have to do this homework, you want to know the process. So the first thing to do is to transfer a debit to the cash account dated May 1st and a credit to the capital account. So that you'd go down to the cash account, stick in your date, which is the 1st, and it came from journal page came from journal page 1, that'd be general journal page 1, where you debited cash, and you're now transferring it in to the account, which establishes the $8,000 balance. It's a debit balance, of course, because you entered a debit, it added to the cash account, and then we have to go to the capital account, okay, and then stick that $8,000 credit as of May 1st Okay, the posting reference, it came from General Journal page 1, and you put a credit in there for the same $8,000, and that extends to balance of 8,000 bucks, and then that first transaction is considered posted. Okay, I'll do one more, and then I'll be posting directly from the transactions to make things faster. Now, typically you would, and I don't see it here, typically you would enter the account number to which the item was posted. So you'd have like a 111 here and a 311 there, but let it go. Next transaction occurred on the 4th. We have a debit to equipment and a credit to accounts payable. You can see I already took those from the transactions to the journal and now to the ledger. So we find the equipment account, May 4th, debit equipment, where'd it come from? General Journal page 1, adding to the asset, okay, and adding to the accounts payable, so that we need to enter the amount, $1,300. That adds to the equipment account, which gives it a balance at that point of the 1,300 bucks. So that posting is complete, and you can see the rest of these guys were already recorded and were explained to you as I recorded them. So rather than going back and forth, let me just continue, and it's easy enough to get these guys posted right over. You know they're in the journal, but it's easier for me to demonstrate this just by going into the accounts from the transactions, again, that are already in the journal. So we've got billing to sister company on the 15th. So we put the 15th in there, and we're still in, and I believe all of these entries come from journal page 1. We're adding to an asset here. Accounts receivable represents an asset to us based on the fact that we have a claim, a valuable claim against another person who owes us $2,000 and establishes a $2,000 balance in the accounts receivable account. The credit part of that entry went to the revenue account, and again, you can see it in your journal above. You can scroll anytime you want, but we'll just move along here to keep things expedited. Okay, so anyway, we got the fees earned of $2,000 that was recorded on the 15th, so we stick the 15th in there. It's already in the accounts receivable account, am I right? Yeah, so I already debited the $2,000 there, so I got to come down and credit into the fees earned account, again coming from journal page 1, and the credit entry which was recorded in the journal now goes into the account itself, establishing a $2,000 balance in that account. All right, and also recorded in the journal was a cash revenue transaction occurring on the 18th. So what we'd be doing is from the journal to the ledger, we'd be putting the we'd be putting 7,000 of cash. Now note what happens here. That came from journal page 1, correct? It's another debit to cash, right? We had this $8,000 in there from the investment. Now we're picking up 7,000 in cash, also a debit. Now, to extend a new balance, you simply ask yourself, well, you just added $7,000 to the 8 that was in there, so now you're up to 15,000. So you stick that in, and you extend the balance, of course, after every transaction, as would be done in a real accounting system. As soon as you hit enter from the journal, it goes to the ledger, and if you went to the ledger, you'd see the $15,000 balance in there. So we need to go to the revenue account, which is right down here, and the $7,000, of course, is going in on the 18th. Right, on the 18th, and we're going to refer it back to General Journal page 1, another revenue earned, this time $7,000, so you're going to credit the account again, and I think you're beginning to see that the account balance will go up. A credit increases another credit that was already in the account, so you had a credit there of $2,000. Now another credit just popped in is going to take this balance up to $9,000. I had $700 in there. I made a mistake. I had to correct it. The posting date is the transaction on the 18th. All right, and I already got the credit side in, so we'll just pick up from there. I made a mistake. They would have got me later on that one, but I remembered that I thought I did something wrong, and I did. Okay, so salary expense on the 24th, go down to the salary expense account, stick 24 in there. Where did it come from? The same journal. And we're adding to the expense account, so we're taking from the journal to the ledger $1,000 of expense, creating a $1,000 balance in the salary account. Okay, now if I debit it again for the next paycheck, it'll go up. 2 debits equal a larger debit. So that takes care of the salary expense, which again I have journalized and just posted it down. And that last one that you had in your journal, you can see what I did up here. I posted all these guys as if I posted from the journal. So that the withdrawals, 200, gets debited to the withdrawals account. I stick the right date in. Where is it? Over here. Okay, so we stick the 28th in there, and the reference again indicating that if you had to look back, if you were analyzing that account, you would go look back in that journal dated the 28th in that journal page. That's why we put the reference in there, so we can go back and forth from the journal to the ledger to see the sources of the posting and the explanations, which are in the journal. So there's the $200, and that would leave a balance of $200 in the withdrawals account. Okay, so that should take care of the transactions, but now I have to put the balances in before I can prepare the trial balance. As you can see, I still haven't, let me get this down here, I still haven't checked the answer yet. I think I have to put the balances. Why is there nothing in accounts payable? That's weird. Ooh, did I forget a posting? Did I debit equipment and credit accounts payable? You see that? I would have got nailed on that. Alrighty. So it's kind of good for you guys, rather than get nailed, to just quickly review it like I'm doing here. And I still might have made a mistake, but I'll know sooner or later, as soon as I check the answer. So that transaction on the 4th, I didn't, and I should have credited. Maybe you picked up on that as I was going through this. So that was the 4th, right? And I forgot to put the what? The whole posting, the whole line I messed up on. So there's the credit of 13, which was the addition. We credit liabilities to add to them, and you calculate a balance, and there you go. So I should be okay. Now when I pay this liability off, you kids, say if I paid $500, what would I do? I would debit if I paid $500 to reduce it. And then that would reduce the credit balance to 800. So the balance goes up and down as you incur and pay off liabilities. I think I can check the answer at this point. I probably screwed something up, but let's go. Oh, I did some. There was an error in one from the 24th and or the 28th. All right, let's go see what I did wrong. The 24th paid salaries of $1,000. Let's see what I did. I should debit salaries expense on the 24th here, 1,000. So the debit is correct, right? And there's the debit balance. Let's check the credit. That was the 24th, right? They said the 24th, the 28th, something's wrong. So I should look into my cash account. And, oh, I'll be darned. Okay, welcome to my world. All right, so I screwed that up. So it's nice that they tell me what I did wrong. Let me put the 24th in there. And GJ1. So it's good that I'm not intentionally making these mistakes, but showing how it comes up and gets you. So that would have been a $1,000 reduction to cash. All right, I'm kind of glad this is happening. So if you put a credit into an account, has a debit balance, and you put a credit of 1,000, you're reducing. So good exercise down to 14,000. I think that fixes that one up. They mentioned the 28th. Let's make sure I got that in there. Look at me. Well, what a space shot I am. I don't even have the 28th in there. Oh, my God. All right, so what occurred on from GJ1? All right, I have the reference, and what did I do? I took out $200. It's in the journal. I just blew it. That's why it's so good to operate in an automated, completely automated system, where as soon as I record the journal entry, it's going to go right to the ledger and calculate the new balance. So there's the $200 entry that goes in there, and that's going to bring another credit is going to bring that down to $13,800. All right, so my balances should be correct. Given that, let's just see if I fixed everything. Check answer. Okay, I'm good. I'm into this for quite a few minutes, but I'm not worried about it. Let's finish it off, because I don't think you've seen it. I don't think you've seen me prepare a trial balance. We have to check answer. Let me get rid of that. Check answer. I don't know where I'm supposed to be. What is this? What the hell's going on here? Oh, now they want me to, oh, okay. Now they want me to go put the references in. All right, it's kind of a back-asswards thing now. So this is the journal. So now they're showing me that I have to put the account numbers to which the transactions were posted. Okay, that was 311. And the equipment. Remember I told you, typically you put equipment's number 121. Typically in the journal, you put in the account number of the account to which the entry was posted. And I did post to account 211. So they're having me do it now, as opposed to having it done electronically. Receivables 112. Fees earned is 411. Alrighty, so what we know is if we wanted to go find that entry in 411, we'd go look into 411 and make sure that 2000's there. Again, that 111 is cash, and fees earned 411. Okay, and then we have salaries expense, which is account 511, so we'll know that we're we can refer to that account to make sure the thousand's in there. And then the cash account came down. All right, I think I'm cool. I hope I am. So we went 111 to 311, 121, asset to liability, asset to fees earned, revenue account, asset cash to fees earned again. 511 is the salary expense, and the withdrawals account wasn't there before. That's not in view anyway. 312, and then from cash was 111. So it looks like I've got the whole journal posted. All right, kids, cross your fingers. Oh, thank God. All right, well done. All right, now the third and final part is to take your account balances from the ledger to prove equality of debits and credits. All right, now I can't get everything all on one page here, but I've got to carry a debit balance into the cash account for 13.8. This is the preparation of a trial balance. I believe I had account 13.8 debit balance. Let's just double check. 13.8 debit balance, 2,000 debit balance, 2,000 debit balance, accounts receivable, 2,000 debit balance, accounts receivable, 2000, back up here, 1,300 debit equipment, that's the balance, 1,300 equipment, 1,300, good. Next account after the equipment is a credit balance account. So you take the same credit that you have in accounts payable and make sure you put it in as a credit balance in accounts payable on your trial balance, 1,300. Double check that I put the right amount in. Accounts payable, yes I did. Then I've got the capital for $8,000, credit, the withdrawals 200 debit. So capital for $8,000, capital for $8,000, credit balance, and a $200 debit balance to the withdrawals account. And then the remaining two accounts are the fees earned, 9,000 credit, salary expense 1,000 debit. Fees earned, 9,000 credit, so it's debit for debit, credit for credit from the ledger to the trial balance. And the last one was what? The expense, $1,000 debit from the ledger to the debit balance side of the trial balance. So there's your salaries expense account, $1,000. And then we got to get the totals. Okay, so what I did is I popped the balances and I got it to balance after adding these numbers up on both sides. So what you're seeing here is that the trial balance balances, and hopefully I did it all right because it seems like I finished, unless I blew something. Check my answer. Good job. Okay, so that is that question of your homework. I don't know whether you got the same names and numbers, but that's the essence of it. And if you understand that process, are able to analyze each transaction, record it properly, debiting and crediting the right accounts for the right amounts, posting properly into the ledger, adding and or subtracting as the case may be, getting your ending balances intact, and then simply transferring from your ledger to the trial balance, then you did a good job. Okay, so I know it's long, but it's a good one.